Hey, good morning, everyone. Marty Mazzori here. It is the 9th of July, 2025, Pacific Standard Time, 2.5 hours before the stock market closes today. So, folks, I've got, I think, important stuff to cover with you, and I'm going to do it backwards again, like I did last time, relative to what I usually do, and I'm going to show you the market stuff first, or the charts. And let's just get that out of the way. And I want to keep you engaged, though, because the good stuff comes at the end when I share some data points with you. So I won't spend a lot of time on the charts. I am starting today, though, with breadth. So as I speak, the Dow, for example, is up. Where'd it go? The Dow is up. Well, it's only up 64 points now. So this is a delayed chart. Just, gosh, seconds ago, it seems like it was up 100 points. And this is delayed by 15 minutes on the Bloomberg terminal. But as you can see here at that moment, 15 minutes ago, while the market was up more, half of the Dow stocks were down. Okay, the S&P, when I looked at it a few minutes ago, or again, not even that long ago, was up closer to 40 points or 40 bips, 40 basis points, 0.4%. Now it's 30 basis points. And you can see it's about an even split. So the market is up, or the S&P is, but almost half of the stocks in the index are down. I suspect it's more than that now, since it's 15 minutes later than this and the market's come back a little bit. And then the NASDAQ 100 index, although this is a NASDAQ composite, but it's got more stocks in it, but it's up today. And not quite 50-50, but lots of down stocks. So this is another one of those days where the breadth isn't great and the market's up. Fund or a core allocation like ours, it's up 10 basis points, so up 0.1% so far today. And we were flat for most of the day, largely because gold was down, and it's up a little bit right now. Consumer staples, which is a pretty good position for us in the U.S., are down over 1% today. Okay, so big blue chip U.S. stocks that sell the stuff people got to buy if they want to keep living, that's down a lot. That would be the equivalent of 400 plus Dow points, just that particular sector by itself. So that's what I mean by the breadth not being so good, meaning that all boats are not rising with today's slightly rising tide, I guess I should say. The equal weight index, which basically gives equal weight to all the S&P 500 stocks, is actually down 0.05%. So you get it. That's not the sign of a healthy market, but this is just one day. So we've had really good breadth days, really bad breadth days. The breadth indicators, which I didn't load up, that I went through in great detail over the weekend, are showing negative divergences, meaning the last time we were at all-time highs, the breadth readings were notably stronger, and that's not a good sign for the sustainability of the current level of the market. So speaking of that, looking at the daily chart, folks, nothing has changed. In fact, we're about to get right back into overbought territory on the relative strength index. And you can see typically when we get in that area, often it resolves by lower prices. It can resolve sideways. You can see back here, July of last year, we got overbought, had a pretty good correction. Didn't quite get overbought before this 20% correction that we got so far this year. So these are lofty levels from a momentum standpoint on the RSI, but from the moving average convergence divergence standpoint, it's a very negative divergence, and it's a kind of divergence that I've shown you over the years that tends to presage a decline in the market. So we have a bearish rising wedge pattern that we've just broken out of sideways. You can see this candle right here. The wick of the candle is how high it's been today. The body comes down to where it is currently. Looking at the longer term charts, we pretty much have the same look. And this is what's more concerning for long-term investors. Here is the 10-year weekly chart of the same index, the S&P 500. We actually have kind of the makings of somewhat of a rising wedge pattern right now. Yeah, because this would come down to this high. So yeah, you kind of have that. Very, very notable bearish divergence on momentum. So we're not nearly the momentum that we had at the last all-time high. And same thing on the weekly relative strength index. Why is that important? Well, you can see right prior to this 10% dip, you can see that we had bearish divergences and overbought territory there. Before this 11% dip, bearish divergences, overbought territory, although we're not overbought on the weekly right now. Here's the opposite, falling wedge, bullish divergences right there at that 2022 bottom. Remember, we were screaming that one all day long as it was developing. And then here we are before the 27% decline in 2022 with a look not that different than the one we have right now. I will say that this is coming aggressively off of the low here, and that's a strong short-term buy signal, but the divergence is what's troubling. And then you can see the somewhat of a bearish divergence on the RSI. Before the 40%, 35% for this index decline in COVID, even though it was COVID, we still had a bearish setup going into it. In 2018, this was a 20% correction. Looks a lot like this one in a sense with the bearish divergences and so on. I could go back over and over and over again, folks. And all it says is that, does this mean it's going to happen for sure? No, it just means that the risk of the market rolling over from these levels is pretty high over the next few weeks, let's say. On a monthly chart basis, essentially the same look, as you'll see. You've got definitely have a rising wedge pattern developing in here, ascending triangle maybe. But that is a very concerning look, despite the nascent buy signal here when the white line goes above the red line. And then negative divergence on the RSI. This shows momentum picking back up a little bit. But this is a concerning look, particularly off of these levels. Same thing, slower moving. That's why it's nice to look at these long-term charts, which really are the ones we probably should be paying more attention to. You know, going into the COVID, big drop there. Going into the 2016, 15-16 correction. And then going into the Great Recession, 57% decline in the S&P. And you can see where we got oversold in here and finally bottomed, but we had these bearish divergences, you know, a flat MACD and a declining RSI. And before the tech bubble burst, again, very much so. You know, these divergences. These are patterns that we should be respecting right here in terms of not a time to, you know, back up the truck to the stock market probably. These momentum deficits, if you will, could burn off, and I could tell you a different story, at least technically speaking, you know, a few weeks or months from now. But right now, that's the only story to tell in our view. As for the NASDAQ 100, just know that the longer-term charts look exactly the same or virtually the same as the S&P did. So here's the short-term chart. We have that rising wedge pattern, getting back into it or trying to or struggling to today. But bearish divergences real close to overbought territory. Just a concerning look on the daily charts anyway. And again, a lot can happen. We could just keep barreling into new all-time highs. We generated kind of a bullish narrative for the second half of the year that I shared with you already. That could play out. So it's not necessarily our base case, but we're open-minded to anything at this point. The dollar, I mentioned that it's due for a rally. Technically, it looks like it's ready for a rally. Last time I said that, we lost it right here at the downtrend line. Right now, you could argue that we're looking virtually the same. This would be a very much another bear flag pattern if we break below here. And you can see how the dollar just keeps flagging down almost perfectly to that target. If it does this again, right, you take the length of the flagpole, you know, and that would send us down here, and we'll see. Right now, we're in that space where it wouldn't surprise me to see a short-term sustainable rise in the dollar. I think long-term, the dollar is going to continue to dwindle in value. I think it's almost essential, if not required, given the setup for the U.S. general conditions, if you will, particularly the general conditions of the federal government. And then gold, which I've been pointing to pretty much throughout this whole yellow box right here, this trading zone, that gold is a concern short term. We're crazy bullish long term, if you will. But short term, we think that gold likely will go lower. At least that's what the charts are telling me. I could make maybe a more fundamental case or a more political or geopolitical case, if you will, for gold to continue to go higher. I think it does ultimately continue to probably go a lot higher than it is right now. This is a very compelling bearish chart right now, though, folks. And breaking down below the 50-day moving average yesterday and then testing it a little bit today, and it's testing it right now. We'll see. The technical picture is short-term bearish gold. The fundamental picture is long-term bullish gold. Okay, so there's your wrap-up of the usual suspects that I touch on pretty much every time. Let's look at our latest notes. This chart that I threw in there this morning shows you essentially government receipts, United States financing activities, which is the Treasury statement, deposits and withdrawals of the operating cash deposits, Treasury general account, customs, and certain excise taxes. Customs, folks, this is the tariff revenue that has been collected of late. My goodness. Now, that I'm certain is something that we have not seen historically. That is just amazing, right? So this is what they're after, right? Is that we can raise billions of dollars in revenue. The question being is, who is suffering the consequences, right? Somebody wrote those checks and is writing them as we speak. So the way a tariff works is there's no check written by the exporter from the foreign country, by the way, as it's sometimes presented. That unequivocally is not how technically it works. The way it works is the U.S. importer who buys the good from a foreign exporter gets the bill for the tax or the tariff, and they have to pay it. The argument that the exporter pays it is one where the exporter would reduce the price of the good that they're exporting to compensate for the tariff hit so that somebody in the U.S. will still buy it, pay the tariff, and so forth. No doubt some of that goes on at some point, right? If not from the get-go, but not remotely 100% of it, okay? The importer, the business itself that wants to sell the good to you and me, writes that check. So ultimately, who ends up paying for it? If indeed they eat that cost, meaning they do not pass it on by way of a higher price to you and me, well, that's a problem for the stock market, right? Because that's going to hit their profits. It's going to hit their margins, which are near record highs right now. And as those margins come down, what happens to the stock market? It comes down, maybe big time from these levels. If it passes the cost on to you and me, which no doubt some of that, the consumer is going to have to pay more. Well, that's where people argue that that is what means inflation is going up, right? And higher prices are inflation. Well, think about it for a minute. So not all things are tariffed, and not everything we buy in this country is an import from a foreign country. The tariffed items will get the higher tax, will get tariffed, right? To the extent that they pass that on to the consumer, that means that the consumer has fewer dollars after purchasing presumably the same quantity of that item they were purchasing before, leaving them fewer dollars to spend on other items out there in the economy, right? So those other items are not getting the purchasing that they were previously. And if the producers of those other items want to keep their volumes up, well, then you could argue that that will lower the price, or they'll have to lower the price. And that in that regard, a tariff is disinflationary or deflationary, right? Because it's forcing dollars to be spent on certain items at the expense of other items, okay? So I heard this point made in a very good podcast, and I stopped the podcast and I commented on it only to have the guest in the podcast essentially support what I had said. And what I had said there is, yes, I agree that a tariff could be disinflationary, but it's all dependent on the conditions at the time if we look at it on a short-term basis. If people are in a strong spending mode and there's plenty of liquidity in the marketplace and so on, well, then they would just dissave, right? They would just save less and continue the same volume of spending. In that regard, well, then you could say you would have across the board inflation, but not necessarily or entirely because of the tariff. It would just support that inflation or exacerbate it a little bit until enough is enough and things turn around. And even the tariff item itself, to keep everything else stable, well, then people are going to buy less of the tariffed item. Again, the question ultimately is, if companies are going to absorb a chunk of it, right, thinking in terms of the stock market, well, I already said it, margins and profits come down, stocks have to come down. They are sitting at near all-time record levels, if not there, depending on the metric, based on what's going on currently vis-a-vis earning statements. This is a lot of money. And if this continues, my whole point is somebody's got to pay for it. And let's just not be deluded by recent action in the market. And I'll finish with what I think the market is thinking right now. But before I do that, let me just scroll down to a few other things. And this actually came from that podcast I just mentioned. Here's yet more, maybe it'll be different time, recession warnings. So Eric Basmajian does a great macro job, very objective thinker, really appreciate the work he does. He has a chart here, the prime age employment rate, prime age being ages 25 to 54, and he's concerned about the extent to which that is rolling over. And I've shown you chart after chart of our own that shows these phenomena that happen historically only ahead of recessions, right? There's the Great Recession. There's the tech bubble bursting, right? There is the early 90s recession, right? And that's these gray areas. COVID, it just kind of happened all at once. That you could see, though, it was indeed beginning to top out. Here we are as bad from high levels, though. Okay, so the ultimate level itself isn't horrible, right? But it's the direction and the rate of change that we need to be concerned about in economics. And so here we are looking very recessionary based on this metric, and still no recession, and definitely we're not in recession at this point, folks. Part-time ratio. Now, so this is people who are working part-time for economic reasons, and what that means simply is they don't have any choice. They prefer to have a full-time job, but they can't find one. So they're working part-time for economic reasons. Again, this is inverted, but it shows you essentially what I'm talking about, that when people are working part-time because they have to, not because they want to, that tends to occur, and again, this is COVID, but that tends to occur primarily right before recessions ensue. You can see it topping out here. Again, the Great Recession, the tech bubble bursting, the early 1990s recession right as it was beginning. And I've been showing you lots of these charts that in a world where there is still clearly a lot of liquidity sloshing around because the U.S. printed and showered the economy probably 4 times greater than any other country on earth, that's still in the system. And we paid the price with inflation. We're paying the price, of course, with a massive budget deficit and a big debt pile that there's nothing that's going on right now in the halls of Washington that is changing that even remotely. In fact, what's happening right now with the spending bill and so forth exacerbates it. The hope is that it will inspire the kind of economic growth where we can grow our way out of this, and that's something, of course, we'll be commenting on a lot in the months and years to come. And then lastly, full-time employment as a share of the overall labor force. And you can see that that's really falling off a cliff. So to the extent that people are working and they're working part-time, you can see that that's rolling over like it does when the economy gets into trouble. Did have a blip right here when the bond market blew up. It came close to recession back there in 1994. So there was an exception there where it just fell off a cliff and then recovered. And here we are right now, rolling off of that cliff once again. And who knows? We've got to keep an open mind. Maybe we won't have a recession anytime soon, but make no mistake, as I keep saying, the stock market at least is in no way, shape, or form prepared for that outcome based on what the projected earnings are currently that are priced into the stock market. Okay, and then here's one I threw in there yesterday. And again, I titled it, Yet Another Historically Sound Recession Indicator That Could Be Different This Time. And I'm not just saying that for effect. A small business survey says the single most important problem presently is poor sales. So this chart plots that alongside the unemployment rate. Okay, the unemployment rate is still historically not high, as you can see, right, which is the darker line here. But again, in economics, we want to consider that, but probably more so we want to consider the direction, right, and the rate of change, how fast things are moving in that direction. And these gray shaded areas, once again, are recessions, and you can see what tends to happen prior to recession. Okay, so if it is so obvious, now these are leading indicators. These are indicators that tend to signal what we should expect going forward. The hard data that the Fed says, is okay, and the employment rate is strong, and this economy is in great shape, you want to call that the coincident data. Eric Bassmajian made that point today, and I've shown you our ratio of leading indicators to coincident indicators fairly often. I did that a lot last year, and again, it's a signal that still to this day says recession should be coming. We've never been at these levels without having seen a recession. So if that's all the case, and it all appears so obvious, here's where I want to kind of monologue at you, if I will, for a minute. And I had a great conversation with a friend this morning, client and friend, just kind of what's going on, right? Two people in the last 2 days, one within our own company and one, this client I mentioned, said, quote, well, Trump probably won't let the stock market come barreling down, right? Well, we did have a 20% barreling down over the course of a couple months this year already, and that was, amid the new administration. But I get it, and I get why people would think about that way, and I think that's generally kind of the general feeling in the market, in a sense. Not necessarily that Trump can keep the market from falling too hard, but certainly the desire is there, and I agree. And so far, so good, right? Meaning that when the administration proposes something that would be detrimental to the market, as recently as Sunday, and Monday we get a big decline in the market, suddenly by Monday night, those threats are retracted. And that very much happened again, even this week. So the signal to the market is forget about it, right? Don't worry about it. These things they may be threatened, but they're simply not going to happen. Right now we're seeing that the minute the market punishes, you should have bought. You should have bought whatever dip you get. And so as long as that's the case, you're not going to get much by way of dips because people are going to be rushing in every time the market hiccups, right? Because they just don't believe that these things are going to happen. Now, I did show you this chart. It's up on your screen again right here, right? And that is the one that says, well, it is happening because they're collecting all this revenue. This is not showing up in the data yet. This is not showing up in profit margins yet, if that's where the hit's going to be. And if it does show up in profit margins, that's going to be a problem. And it's going to be a problem that's going to be very difficult to halt once it gets going. Retail investors have record exposure to stocks right now. Foreign investors, despite the big move out to rotation out earlier this year, still are sitting at record levels of exposure to the U.S. market. And I would say the latter are just looking for a catalyst to continue that rotation. So you could get a situation, I do think it'll need a catalyst. It could be a series of economic readings that say inflation is coming back in force because of this and because the economy is holding up okay. And then you get a kind of a 2022 scenario where we go down 27%, not because of recession, but because of interest rates and higher yields, let's say. But if it is, unemployment begins to rise, you are going to see the Fed act, you are going to see them cut rates, you are going to see the printing press ramp up even more to try to circumvent that. And here's the problem, to the extent that they can. And in our internal meeting yesterday, when somebody made the very smart comment, or a very obvious comment that, yeah, but here's all these risks that we keep addressing, but is the administration really going to let them come to the fore, if you will? And the answer is they're going to try not to. Clearly, we've seen that. They've led that example so far in the short 6 months of this year already. But will they be able to succeed? Because here's the problem. If they can arrest the decline in the economy, they are also going to arrest at the same time the decline in the inflation rate. Now, the previous administration was handing out, quote, checks. I've been giving them checks, end quote, like they were going out of style, right? And amid all of this largesse from the federal government, the approval rating of that particular administration was plummeting. Why was it plummeting? Because inflation was ramping up, which makes perfect sense, right? We had a lack of ability to produce the goods and services that were being demanded by a public and small businesses, for example, that were just utterly awash with record amounts of cash. So if indeed they pull out the stops and start throwing liquidity into the economy, well, look out above for inflation and higher interest rates, and that is going to be problematic. When it's all said and done and the monetary authorities have to react to it, then you're going to get your recession. Maybe it's not till next year if indeed all this comes to pass. And now we're talking about running deficits, so we're going to grow our way out of it. Bessent's dream of 3% deficits, no more talking about that. We're talking 6 and 7% budget deficits now. And so because the markets just wouldn't allow for it. And so, kind of in a nutshell, this is that whole rock and a hard spot analogy, right? In that if you continue to try to keep things afloat, keep a normally cyclical economy from cycling, it's going to have to come out in the wash somewhere, and it's going to come out in a place where people hate it, and that is higher inflation and higher interest rates. The stock market is priced at virtually all-time highs with rising interest rates, creating more attractive opportunities elsewhere, hiking borrowing costs for companies at these levels and so forth, amid other things that could be hitting their margins already. That could be very, very messy as well. In a recession, people quit spending money, margins come down, profits come down. That could be a mess as well. So at best, you'd have to say there is limited sustainable upside in the U.S. market, save for some productivity miracle. Maybe it'll be artificial intelligence. That remains to be seen. I could talk for an hour on that if you like, but I won't do that today. And so anyway, we have had a remarkably good first half of the year as a firm on behalf of our clients and our core allocation, largely because we're not all in stocks, not all in U.S. stocks, and we have other things like precious metals that have been making a real difference for us. But we take nothing for granted. The second half of the year is going to be every bit, if not more challenging than the first half. So we're all going to have to stay on our toes, folks, and we're going to have an eye on playing some defense amid these conditions that I continue to point out to you twice a week, every week. I will stop there. Thank you for staying with me all this time, those of you who are still there or still awake. And I'll talk to you late in the week or over the weekend. Have a great day. Take care. Bye-bye.